folks, today I'm going to walk you through two examples of a bull put spread using SPY. So the first one back in May, if we go and look at the price chart here, this is just using OptionNet Explorer, by the way. You can check out my review of that if you like. We've got the S&P 500 here, had a big gap up, 3% up day. We're above the 20-day moving average, which is rising. We're above the 50-day moving average. We're going out to June, so a 1 month trade, and we're selling the 15 delta and going 5 points wide with 5 contracts. So that 15 delta is at 265. So that's our strike down there below that 50-day moving average. And there's our risk graph. All right, so there we go. Let's just walk through the trade. This first one's a pretty stock standard sort of trade, no adjustments needed, just sort of does its thing. So we'll go through day by day and you can see how the trade progresses. What I might do is I might use the player here, which will make it a bit quicker. So you can see here, S&P 500 is rallying a little bit and time decay is kicking in. We're at about 50% of profit here. We could potentially close the trade out here, but we'll continue to watch it through as we get closer towards expiry. Pretty standard sort of easy trade. Not much goes wrong with the trade, pretty much in profit from day one and just does its thing. And there you go. You can pretty much close that out there at that point. There's not much premium left. So that one's pretty easy, pretty standard. You love when that sort of thing happens. The second example is a little more challenging, and I'll share with you a couple of strategies as well in terms of how we could have managed it. All right, so let's go here. So this is our second one. Again, pretty standard sort of setup. It was the end of August. We're going out just under a month, and we're again doing that 15 delta, which is 325, 5 points wide. So similar setup. And if we look at our price chart there, everything's looking pretty bullish at this point. And we're down at 325, which is down here. So, you think that's a reasonably good entry point, other than the fact that maybe we're a little bit overbought, something like that. But, not a bad entry point. The trade starts out pretty well. And after a few days, we're in a nice profit scenario. A couple more days, I think. All right, so here within 6 days or so, we've achieved 50% of the profit potential. So that's a point where we could close out the trade. I'd normally close that out there, but if we go and move forward in this trade, you'll see the S&P 500 then starts to crash down over the course of a few days. So look, there's a couple other things we could do here. If we didn't want to take profits here, we could potentially lock in a little bit of the gain here by reducing the number of contracts or by bringing the strikes in a little bit. So we could buy back, say, three of the contracts. So you can see there now we've only reduced our profit potential by a little bit, but we've significantly reduced our risk. Or, similar effect would be moving the strikes in a lot closer. Very similar sort of adjustment. But let's say we didn't do any of those sort of things and we just held on to it. We didn't close it out. We didn't make any adjustment. And then over the next few days, the S&P 500 starts to drop. So there we go. We had a 3.5% down day, pretty significant. And at this point, again, you're not hitting that stop loss yet, but with a day like that, that's usually a bit of a warning sign. So again, if you didn't close it out, you held on another day, it's always good to see how these things perform in all sorts of different markets. Still only down $120. But then the big losses start to come in on the next day. So there's plenty of chances to get out of this trade early, down $400. I just wanted to share that with you in terms of, a couple of little management rules when you're taking profits or reducing risk on a winning trade. Let's just go back to, when was it? The second. So let's say on this day we had have tried to lock in some profits. Maybe we just rolled these up. Let's compare how that would have performed. All right, so there's our new trade, much less capital at risk. And we'll fast forward, I think it was about the 9th. So in this case, we're still in the trade. We've only lost $128 instead of that $400. So a couple of little strategies. Yes, the right thing to do would have been to take profits. But if you didn't, you could have at least adjusted to minimize your risk, and you would have been able to weather that storm a little bit better. So a couple of bull put spreads there. Hope you enjoyed that. Any questions, let me know, and I'll talk to you soon.